Within the next 24 hours, bank accounts belonging to millions of Americans will show deposits that could reach $2,400. For those depending on Social Security to cover essential expenses, to keep utilities connected, to purchase groceries, and to maintain basic living standards, missing crucial information about this payment cycle could result in losing money that you have rightfully earned through years of contributions to the system. A significant wave of deposits has been confirmed for the coming day. However, what remains unclear to most recipients, what gets buried in complicated correspondence from the Social Security Administration, is that payment schedules vary significantly between beneficiaries. Not every person receives their funds on identical dates. Grasping the specifics of your individual payment timeline could be the deciding factor between organized financial management and unexpected monetary challenges. Between precisely scheduling bill payments and facing surprises when expected, funds fail to materialize. Currently, the Social Security Administration follows a rigid calendar framework determined by your date of birth and when you initially began claiming benefits. This arrangement is neither random nor capricious. It represents a meticulously constructed system that has functioned for multiple decades, specifically engineered to handle the enormous logistical undertaking of distributing tens of millions of payments every 30 days. For individuals born during the 1st through 10th day of any month, funds arrive during the 2nd Wednesday of each calendar month. Those born between the 11th and 20th receive payments on the 3rd Wednesday. Anyone with birthdays falling between the 21st and 31st can expect deposits on the 4th Wednesday of each month. But the critical element emerges here. Supplemental deposits, cost of living adjustments applied to your benefits, and potentially one-time payments you might qualify for can dramatically alter these amounts, pushing your deposits substantially higher than your accustomed figures. The genuine question extends beyond simply knowing when money arrives, though that certainly matters. The real issue concerns whether you are receiving everything you have earned, whether you are leaving entitled funds unclaimed after decades of system contributions. Let me break down precisely what arrives tomorrow, who qualifies for these deposits, which factors can increase your payment amounts, and critically, how to confirm you are not leaving any funds unclaimed. Every single dollar carries weight when living on fixed income. When inflation steadily erodes purchasing power, when medical costs continue climbing while Social Security increases never seem adequate, most people fail to realize, often until significant time has passed, sometimes months or years of missed opportunities, that the Social Security Administration processes more than 70 million payments monthly. Each calculation follows complex regulations, delivered according to strict schedules, and represents someone's fundamental livelihood, their survival capability. That system has been carefully designed across decades, refined through continuous improvement. But here lies what troubles financial advisors. Thousands of seniors miss out on money already earned, funds rightfully theirs, simply because they fail to understand how this system actually functions. When discussing a $2,400 deposit arriving tomorrow, we are not merely referencing your standard monthly benefit. We are addressing a combination of factors including your primary insurance amount, which represents the base calculation of your entitlement, any cost of living adjustments applied to your benefit across years, which accumulate over time and can significantly boost your payment, potential back payments if processing delays occurred with your application or if corrections were necessary to your earnings record, and supplemental payments you might qualify for based on specific circumstances, whether that involves supplemental security income, survivor benefits, or additional programs. Now let me explain the actual mechanics of how tomorrow's payment batch operates. The Social Security Administration implements a staggered payment schedule, a system spreading payments across different days throughout the month. This schedule has existed since 1987, when Congress determined that sending all Social Security payments on the 3rd of every month created massive logistical problems for banks and financial institutions nationwide. Imagine tens of millions of deposits all processing simultaneously, so they divided it based on birth dates, creating more manageable payment flows throughout each month. This represents crucial information every beneficiary needs documented somewhere secure. If you started receiving benefits before May of 1997, you belong to what they designate the legacy group, and your payments arrive on the 3rd day of every month, regardless of your birth date. This group includes people receiving Social Security for decades, long-term beneficiaries grandfathered into the previous system. But if you started receiving benefits after that cutoff date, if you are among the majority of current beneficiaries, then your payment day depends entirely on which portion of the month you were born. Here is where confusion typically begins. The Social Security Administration does not exactly make this information readily accessible. It gets buried in frequently asked questions on their website and mentioned in letters using confusing governmental language. When examining your birth certificate, that specific day you were born determines your payment, Wednesday. The second Wednesday of the month belongs to people born between the 1st and 10th. So if you were born on January 5th, March 8th, or October 2nd, you belong to the second Wednesday group. The third Wednesday goes to those born between the 11th and 20th. And the fourth Wednesday is reserved for anyone born between the 21st and 31st. But tomorrow's batch carries special significance, different from typical payment cycles. Additional payments are being included that do not follow normal schedules, payments that some beneficiaries qualify for, but do not even realize they are entitled to receive. And if you are not paying attention, if you are not checking your account and comparing it against what you should be receiving, you might miss important information about money that legally belongs to you. The $2,400 figure is not arbitrarily chosen. The average Social Security retirement benefit currently sits around $1,760 monthly for individual retirees. That represents what typical beneficiaries receive. But here is what makes this particular payment batch different from standard months. We are examining a combination of regular monthly benefits plus potential supplementary payments that some seniors qualify for, but many remain unaware even exist. These supplementary payments can originate from several different sources. Understanding them can mean the difference between getting what you deserve and leaving money unclaimed. If you are receiving the maximum Social Security benefit because you worked for 35 years at or above the maximum taxable earnings limit, meaning you paid the maximum amount into Social Security annually and you delayed claiming until age 70 to maximize delayed retirement credits, your monthly payment could reach as high as $4,973. That represents the absolute ceiling that anyone can receive, but most people are not getting that amount. What we are seeing with tomorrow's deposit involves something more nuanced. The Social Security Administration periodically issues what are called supplemental payments. First, there is the annual cost of living adjustment, the COLA you hear about every October. This means if you were getting $1,800 monthly last year, your payment automatically increased. That represents an extra $45 monthly, which accumulates to $540 across a year. Not a huge amount, but meaningful when every dollar counts. But here is where it gets tricky, where complications arise. Sometimes the Social Security Administration makes errors calculating these adjustments. They are processing millions of payments with complex formulas and mistakes happen. Human error, computer glitches, outdated information in the system. And when they catch these errors, when they discover that your cost of living adjustment was not applied correctly or that your earnings record was wrong, they issue back payments to compensate the difference. These back payments can add several hundred or even several $1,000s to your regular monthly deposit. And they usually arrive without much warning, except for a mailed notice. Many people see surprisingly large deposits and do not understand where the extra money originated. Another source of additional funds in tomorrow's batch could relate to supplemental security income. This differs from regular Social Security retirement benefits. Supplemental security income is needs-based, meaning it is designed to help people with limited income and resources regardless of their work history. You do not need work history to qualify. The monthly federal payment is around $943 for individuals. If you qualify for both Social Security retirement and supplemental security income, these payments are calculated separately and sometimes arrive in the same deposit, which can make your total monthly income appear much higher than your base Social Security benefit alone. The key thing to understand is that supplemental security income payments actually follow different schedules than regular Social Security. They typically arrive on the first of the month, but when payment dates fall on weekends or holidays, things get shifted around, and multiple payments can end up hitting your account simultaneously. This creates confusion for people who see larger than expected deposits and do not realize it is actually two separate programs paying out at the same time. Let me discuss something that hardly anyone addresses, but absolutely should. Something that catches many retirees unprepared when tax season arrives. The taxation of Social Security benefits. This is critical information because depending on your total income from all sources, you might have to pay federal income tax on up to 85% of your Social Security benefits. Now, before alarm sets in, understand that this does not mean the government takes 85% of your check. It means that up to 85% of your benefit amount could be considered taxable income when filing your tax return, subject to your regular income tax rate. Here is how it functions. The IRS examines what they call your combined income, which is your adjusted gross income from all sources, plus any non-taxable interest you receive during the year, plus half of your Social Security benefits. They add all of that together. If you are filing as an individual and your combined income falls between $25,000 and $34,000, you may have to pay income tax on up to 50% of your benefits. If your combined income exceeds $34,000, up to 85% of your benefits may be taxable. For married couples filing jointly, these thresholds are $32,000 and $44,000 respectively. These are crucial numbers to know when planning your retirement income and taxes. Now let me discuss something that affects thousands of beneficiaries but rarely gets explained properly. The windfall elimination provision and the government pension offset. These are two rules that can significantly reduce your Social Security benefits if you also receive a pension from work where you did not pay Social Security taxes, which is common for certain government employees, teachers in some states, and people who worked for employers who opted out of Social Security. The windfall elimination provision can reduce your Social Security benefit by up to half of your pension amount, though there is a maximum reduction limit that gets adjusted annually. The government pension offset primarily affects spousal and survivor benefits, and it reduces those benefits by 2/3 of your government pension amount. These provisions are incredibly complex, filled with exceptions and special cases, and many people do not discover they are affected until they actually apply for benefits and see a much smaller payment than they were expecting. Here is something else that is absolutely essential to understand about tomorrow's payment. The difference between your primary insurance amount and your actual benefit amount. These are not the same thing. Your primary insurance amount is the benefit you would receive if you claim Social Security at your full retirement age, which is 67 for anyone born in 1960 or later, but your actual benefit amount depends on when you choose to start claiming. This decision can have massive impact on your lifetime benefits. You can claim as early as 62, but if you do, your benefit gets reduced by approximately 30% compared to waiting until your full retirement age. On the opposite side, if you delay claiming past your full retirement age, you earn delayed retirement credits that increase your benefit by 8% for each year you wait up until age 70, when the credits stop accruing. So someone with a primary insurance amount of $2,000 would only get about $1,400 monthly if they claimed at 62, but would get $2,180 monthly if they waited until 70. That is a difference of over $1,000 monthly for life. This is precisely why some people receiving tomorrow's payment are seeing amounts that seem surprisingly high compared to what others are getting. They are collecting those delayed retirement credits that they earned by waiting to claim benefits. Let me share something that financial experts know, but most regular folks do not. Social Security benefits can continue to increase even after you start receiving them, and not just because of cost of living adjustments. If you are working while receiving Social Security benefits before reaching your full retirement age, there is an earnings test that can temporarily reduce your benefits if you earn more than a certain threshold. For this year, that threshold is $23,400 for people who will not reach full retirement age during the year. If you earn more than that, the Social Security Administration withholds $1 in benefits for every $2 you earn above the limit. But here is the good news that nobody tells you. Those withheld benefits are not gone forever, not taken away permanently. Once you reach your full retirement age, the Social Security Administration recalculates your benefit to account for the months when benefits were withheld, effectively giving you credit for those payments in the form of a permanently higher monthly benefit going forward. Another factor that can boost your payment, potentially creating a back payment that hits your account unexpectedly, is if the Social Security Administration discovers that your earnings record was incomplete or incorrect. This happens more often than you would think, especially for people who had multiple jobs throughout their career, worked for small businesses that might have had payroll issues, or had name changes due to marriage or divorce that caused administrative confusion in the system. The Social Security Administration is supposed to automatically update your earnings record each year based on what employers report. But mistakes do happen. If you have ever checked your Social Security statement and noticed that your earnings for a particular year seemed wrong, and you contacted the Social Security Administration to correct it with documentation like W-2s or tax returns, you might see an adjustment payment when they recalculate your benefits based on the corrected earnings. These adjustment payments can be substantial, especially if the error affected multiple years or occurred during your highest earning years, which are the ones that matter most for your benefit calculation. Let me discuss survivor benefits for a moment, because this is another area where people can see unexpectedly large payments. If you are a widow or widower receiving survivor benefits based on your deceased spouse's earnings record, you might be entitled to more money than you are currently receiving, especially if your spouse had delayed claiming their own benefits or had high lifetime earnings. Survivor benefits are calculated based on what your spouse was receiving or would have been entitled to receive, and they can be as high as 100% of that amount, depending on your age when you start claiming them. If you claimed survivor benefits early and are now at or past your full retirement age, you might want to check whether switching to your own retirement benefit would give you more money or vice versa. The rules around this are complicated, but the Social Security Administration allows you to switch between different types of benefits if it is to your advantage. Many people do not realize this option exists, that they can potentially increase their monthly income by switching from one benefit type to another. Here is something about Medicare premiums that directly affects your Social Security payment and might explain why your net deposit amount changes from year to year, even when your gross benefit stays the same. If you are enrolled in Medicare Part B and Part D, those premiums are typically deducted directly from your Social Security payment before it hits your bank account. The standard Part B premium is $185 monthly for most people, but if your income exceeds certain thresholds, you will pay an income-related monthly adjustment amount that can push your premium much higher, potentially several $100s monthly. These thresholds are based on your modified adjusted gross income from 2 years prior, so your premiums this year are based on your tax return from 2 years ago. If you had a one-time spike in income 2 years ago, you could be paying higher Medicare premiums this year, even if your current income is much lower. The good news is that you can appeal these premium adjustments if you have experienced certain life-changing events like retirement, loss of a spouse, or loss of income-producing property. Now let me address something that causes confusion every single year: the timing of cost of living adjustments and when they actually show up in your bank account. The cost of living adjustment is announced in October of each year, and it takes effect for benefits payable in January of the following year. But here is where timing gets weird. December's Social Security payment is actually January's benefit paid early because of the holiday schedule. So when you see news about a cost of living adjustment increase taking effect in January, you might actually see that increase in your December payment, depending on your payment schedule. This is why some people notice their payment amount changed in what seems like the wrong month. It is not a mistake. It is just the Social Security Administration's way of handling the calendar around holidays. Let me tell you about direct deposit versus paper checks, because this still matters more than people realize, and it could affect whether you get tomorrow's payment quickly or have to wait additional days. If you are still receiving Social Security payments by paper check in the mail, you are in an increasingly small minority, and more importantly, you are at risk of delays, loss, and theft. The federal government has required direct deposit for all benefit payments since March of 2013, with only a few exceptions. Paper checks can get lost in the mail, stolen from mailboxes, delayed by postal service issues, or damaged in transit. They also take longer to access since you have to wait for mail delivery and then either deposit the check at a bank or cash it somewhere. If you are still getting paper checks and tomorrow's payment is supposed to include yours, you need to understand that it will take several additional days to actually reach you compared to people who have direct deposit set up. The Social Security Administration strongly encourages everyone to sign up for direct deposit, and if you do not have a traditional bank account, you can use the Direct Express debit card program, which is specifically designed for federal benefit recipients and acts like a bank account for receiving your payments. Here is something about appealing Social Security decisions that every beneficiary should know, but most do not. If you believe your benefit amount is wrong, or if the Social Security Administration made a decision about your benefits that you disagree with, you have the right to appeal. You have 60 days from the date you receive a decision to file an appeal, so time is critical. There are 4 levels to the appeals process. The first level is called reconsideration, where someone who was not involved in the original decision reviews your case. If you disagree with that decision, you can request a hearing before an administrative law judge. Beyond that, there is review by the Appeals Council and potentially federal court review. The important thing is that you do not just have to accept what the Social Security Administration tells you if you genuinely believe there has been an error. Many people have successfully appealed benefit calculations and received years' worth of back payments as a result, sometimes tens of thousands of dollars that they were owed but were not receiving. The key is documenting everything, keeping copies of all correspondence, gathering supporting evidence, and not missing those appeal deadlines because once they pass, it becomes much harder to challenge a decision. Tomorrow's payment batch represents more than just money hitting bank accounts across America. It represents the fulfillment of a social contract that has been in place since 1935. You paid into this system throughout your working years with every paycheck contributing through payroll taxes, money taken from your earnings before you even saw it, building up your future benefits, and now you are receiving the benefits you earned through decades of hard work. Through all those years of paying into the system, understanding exactly how much you should be getting, why that amount might vary from month to month, what factors can increase or decrease your payment, and what additional benefits you might qualify for is not just about being informed. It is about ensuring you receive every single dollar you are entitled to after decades of hard work and contribution. So check your account tomorrow, verify the amount matches what you are expecting, and if something seems off, if the number is lower than it should be, or if you think you are missing payments you qualify for, do not hesitate to contact the Social Security Administration or speak with a financial advisor who specializes in Social Security benefits. This is your money. This is what you earned through years of dedication and contribution to the system that now supports you.